I guess I'm going to throw this one over to João. Can you explain to the futures and options traders what a CFD is?
Definitely. So the CFD is nothing more than an arrangement or an agreement between an investor and a CFD broker in terms of the difference of a price of a financial product. So comparing CFD with futures, as we were saying, here we are not. The client is not owning the underlying product of this financial product, but just the trading and buying or selling and benefiting from the price change of that asset. There are a few differences, I would say, between the CFD and the futures. I think the most important ones are definitely in terms of holding this asset or not. Here we are talking about a CFD. We are just taking advantage of the fluctuation on the price, not holding the physical asset or the commodity, for example. And there's no expiration price. So basically we are trading over the counter, not on a regulated exchange. We are just trading the price and the fluctuation of these assets over the counter. So this might represent maybe more risks from the client perspective, but also more flexibility, because we are talking here, especially for smaller investors. CFD allows you to divide and to buy and sell in smaller portion, let's say, of a specific asset, because you can open a 0.01 lot contracts of a specific asset, so it's way more flexible. On the other hand, I think that here we are always talking of in terms of the ownership, as I mentioned, trade sizes, expiration date. Asset classes is also an important point, because I think there are less asset classes in the futures. CFDs covers way more classes such as ETFs, indices, currencies. Now even cryptos, etc., is now the placed available via trading platforms to CFD traders. So I think that is a much more flexible instrument for a client, especially for smaller investors, retail investors. But on the other hand, there's less control. There's more flexibility for the broker as well, in the sense that there's brokers who can internalize and can do obviously some rebooking and control always the flow of all these trades internally. So is the flexibility versus the less regulation, let's say, of a product, but it will give you a much wider range of assets to trade, and so it's I think it's a nice way in terms of distributing your portfolio into different asset classes in a much flexible way.
I was always curious how like market makers kind of cover their longs or their shorts in terms of CFDs. In terms, do they have to go and buy the asset, or how do they cover for that?
Because you can do that even with the CFD with the price, because you get the liquidity also on the CFDs from your prime brokerages or different liquidity providers that you might have. So from a broker's perspective, brokers are always able to control the flow and to manage the risk internally. Either is a CFD, either is FX, either is different assets. How do you say it? The fact that there's no expiration date makes it easier as well for a client, because an issue when you have a future is obviously you have this specific timeline where you will be able just to close a specific instrument at specific time in the future. With the CFD, you can roll over your position for a longer period. So there's this possibility for the client to diversify into into a more wider range of products.
I guess I kind of like, if a retail trader was shorting a CFD versus shorting a stock, I think with a CFD it allows them to only lose the money that's in their account, but if they're shorting a stock, they might lose their house. So
I think this is also a very interesting point, because I believe practically 99.9% of the brokers have exactly the negative balance protection. So at the end of the day, you are risking what you deposited. So there's this not advantage, but at least peace of mind on that aspect. But yeah, it's I think here you might have the possibility to, especially the CFDs with indices, for example, you have I believe lesser swaps in order to keep your positions open, which also can be a beneficial if you have an idea and you are trading long term and you expect the market to go in a specific direction. You are able to keep your position longer in the markets, waiting for that market movement. So all depends on what is your trading strategy, or the way you like to operate. Also, if you are a smaller investor, it's very difficult to enter into the futures because of the contract size. Because if you start even with the trading $1,000 position, you might be quite exposed if your account is not able to keep that positions open. So here you are able to distribute the risk in a smaller lot size, and also benefiting from the leverage and so on.